Welcome to the Big Mike Fun Podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in, because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fun Podcast. I'm the Big Mike Zlotnik, and today it is my pleasure and a privilege to welcome my good friend, Glen Stromberg. Hi, Glen.
Mike, how are you, man? I really been looking forward to this. I appreciate you having me.
Thank you kindly. Now, I would like to correct this joke because I'm 6'4", a little bit on a bigger side than you, a little bit shorter. I'm much better shape. You've lost some weight, so it's Big Mike and Little Glen, right?
That's right. We're going to take the show on the road one day. That's for sure. So
yeah, we have to do that.
Yeah.
So, Glen, you hail from Dallas Fort Worth area. Tell us a little bit about you. You came back. This is your second appearance on the podcast. I'm humbled and honored to have you, and appreciate you are the Bravo from the CG Mastermind, from the Freedom Founder Mastermind, as I like to call it. You're an officer and a gentleman. But tell us a little bit about your family first.
Yeah, good. Well, like I say, I've got 2 kids, 6 grandkids. So yeah, great family, and so yeah, life is good in that area. I always tell people grandkids are a whole lot easier than kids, and I like that side of it. It's fun, and they call me G-Pop, and so yeah, it's really cool, and looking forward to a good Christmas with them. So that's the family side, and then the business side, we are based in Dallas, Fort Worth, and we do business in 4 states. We do business in Texas, North Carolina, South Carolina, and Georgia. And we, as you know, we have a specialty niche. We buy manufactured homes that are on land. And I always want to clarify for your listeners, this is not mobile home parks. That's a whole nother investment. We're buying existing homes that are already on the land, just like a single family house. Typically, they're a 1,500 to 2,000 square foot double wide manufactured home on a half an acre to an acre tract of land. We buy them, we fix them up like new. That's our secret sauce, by the way. New air conditioning, new roof, new plumbing, whatever it needs to bring it up to the codes to push deferred maintenance down the road. And then we lease them out. We have a full-time property management company, and we do a combination of lending deals where we bring in private investors to lend us the money on our when we're holding the house. Then we do turnkeys also with our private investors. So that's a quick overview of what we do, and everything that we have. It's a deed of trust or a mortgage depending on the state, and so that's our niche, and we like to call it the best kept secret in real estate investing because very few people know about it or get it, and we don't have a whole lot of competition, which is nice. So,
thank you for the great overview. So, what's the difference? So first of all, I agree with you. I don't have grandkids, and having, I guess, grandkids is always easier than having the kids because the kids, they need, they always need little money from you. They need a little bit more of you, and grandkids, you just get to chill out with them. So, but let's put that aside. I agree. Manufactured homes, how do they differ? Obviously, they're very different from a mobile home park. So we clear that out. Now, let's compare manufactured home versus a traditionally built home. These manufactured homes are not kind of homes on wheels. They are manufactured, they are installed, and they basically become one with land, right? It's basically, they marry the land. It's not like they're going to get moved.
Absolutely. And let me give you.
Are these similar to just normally constructed homes? They're just less expensive to construct?
Absolutely, because they run them in an assembly line indoors inside, and they use the same materials. They're using OSB and plywood in the floors, 2x4s, 2x6s in the walls. You can get virtually every amenity in a manufactured home that you can get in a single family home. And it's interesting. My dad was a mason contractor, and he's retired now, of course, but he was a mason contractor and a builder in the Chicago area. He came and looked at 15 of my properties here in Texas, and he went, "Man, these are built better than most track houses in Chicago." So, I mean, it just, and it's funny because when I speak in public, I always show a picture of an old 12 by 60 metal sided house, and I say, "How many people think this is what a manufactured home looks like, mobile home looks like?" 80% of the hands go up. Then we'll show pictures of what we buy, and people go, "Wow, I had no idea they look like that." So, what the beauty of what we do is you're buying the property, you're buying the land and the home together. It's like just like buying a single family home for a half to a third of the cost, depending on the area. The rents are proportionally higher. We're giving the tenants much more, we're giving them more square footage for the dollar. Plus, they get a lot more land too. Instead of 0 lot line houses, they're getting a half acre to an acre tract of land, which, especially during COVID, boy, people, our demand was always great, but during COVID, it was like 3x. It was like 3x because people didn't want to be around people, right? And a lot more people have gone to family office, working out of their home now, so they need more square footage to have an office to work out of their house. And so our demand, like I say, was 3x since COVID hit. So it's been incredible for us, actually.
Yeah, that's really fascinating that you, I guess, can have a same quality, even better home for, I guess, lower cost. And that today's world where there's a lot of cost inflation, it makes a whole lot of difference for folks to be able to get into a property at a lower cost than ground up construction of brand new. Is this because to manufacture a home, whatever factory they get manufactured, drive it to the location, install it, it's a lot less expensive than building it right there at that location? It's just economy of scale kicks in. I'm just trying to understand why there's a substantial difference in cost.
Yeah, economy of scale for sure, because in a factory, a good factory can build 6 houses in a day, right? They've got the labor force. It really is a fascinating thing if you've never been inside a manufactured home plant, how they do it. They just run them side by side. Just they got the flooring people. They just all the different segments lined up, and they build them that way, right? So it cuts the cost of production, cuts the labor cost, all that good stuff. But for us, we're buying existing ones, used ones, and so we're getting a substantial discount from that because we're buying the used ones, right? A lot of the properties we buy, same thing as a single family home, guy, a lot of them need a lot of work, right? So, we'll buy them in all various shapes and fix them up like, it doesn't matter to us because we're going to fix them up like new anyway. So we're getting them at a very, very good price. And as you know, like in America, I've never seen it like this in my whole career. There really is an affordability crisis in America right now. I mean, there's just for rent, for purchase, there's just in most areas, there's just not much affordable stuff. And so it's really in demand right now. And here's kind of the tell. If you go to a new manufactured home plant right now and you order a home today, you can't get it for a year. It's backed up for a year right now. So the market is really, the supply chain is messed up. There's, it's really backlogged right now. So that's part of the problem. That's part of the problem. So.
Yeah, it makes total sense. So I appreciate the clarification that effectively you're picking up existing manufactured homes, and there's really no difference. I mean, everything you said is manufactured or was manufactured in the factory, brought, installed versus constructed at whatever the location is. As long as you can get a better deal, better cost, what would be the equivalent of rent? So let's talk about some numbers. So let's just say you pick up a home. What do you typically pick up today? What kind of a deal? What do you pay for?
Yeah, let me run, and I'll just use. We're in a.
Give me a live example. What does it rent for? What does it cost?
Yeah, let me give you an example here. Okay, so we're in 4 different states, so that's different. Like Texas is higher than the Carolinas and Georgia, right? So, but I'll give you an example in Texas, okay, and just kind of the like where it was 10 years ago and where it is today, right? We used to buy homes for, and I say all-in price, right? Because we don't care the acquisition plus the rehab, that's the all-in price. Doesn't matter, how much, whatever the ratio is or whatever. But back 7 to 10 years ago, our all-in prices were $60,000. Okay, so the ones that we've held, those houses now are selling for $150,000 to $200,000. Okay, why? Because single family homes used to be in the Dallas-Fort Worth area used to be 125 to 150. Now they're 325 to 350, right? And then to break out the rents, right? The rents are proportionally like a 2,000 square foot house in a nice suburb here is probably going to go for 2,000, 2,200, right?
And it's worth 300,000, right?
It's worth three and a quarter probably is probably where it's at. And so if we buy a 2,000 square foot manufactured home, we're probably going to pay today. We're going to pay somewhere in the neighborhood of probably about 90 to 100, and our rents are going to be 1,500 a month. So proportionally, it's much better returns.
All in 90,000, right?
90 to 100. That's
90 to 100. Wow.
90 to 100. Yes.
Yeah, the RV, the rent to value ratio on manufactured homes generates much higher return. The holy grail is 1%. You're actually above 1%. If you're renting for 1,400, you're all in at 100,000. You're getting like a 1.4% a month, which is in today's day and age is incredibly good.
And that's because there's not I'm not going to say there's no competition, right? I don't know of anybody doing it to the scale that our company's doing it, but I mean, obviously there's people that buy them, but that's why I say it's the best kept secret in real estate investing, because people just don't know about it or
Yeah, it is a sort of a best kept secret. Most folks just buy regular homes and renovate, and then they try to flip them. But manufactured is a niche for sure. So what are the opportunities for folks to invest with you? Just talk a little bit about when you have next set of projects. I know you don't do a fund, so you have one-off deals. Right. So what kind of deals do you do with investors? Just curious, what programs you have? What do you offer them?
Yeah, we have two different programs for investors. One, they come in as a lender. They're a lien holder just like a bank. Okay. What we do is we'll do a 5-year interest only note. Okay. 5 years interest only. We pay 6% plus 2 points, plus they're getting 35% shared appreciation. So they're capturing the upside too. That $100,000 house we buy in Texas, right? We're not going to pay more than 80 for that. So you got 20,000 equity going in. And, my guess is, once again, I don't have a crystal ball, but I think inflation is here to stay for a while. I think we're going to see some big time inflation. We already did last year, I believe, but we're going to see it again and again and again. And that's why I believe real estate is just a great place to have your money, because it's an inflation hedge, right? If you're sitting on cash, the CPI index was 6.9% last year, I believe. But people that there's a guy named John Williams, Shadow Stats, and because the government keeps throwing out the stuff they don't like, he said under the old CPI, the real inflation rate was 14% last year. So if you're sitting on cash, you're losing 14%. Real estate.
It's the street inflation. You're preaching to the choir. That I happen to agree with you 100% that the inflation has accelerated, and it's not transitory. It's more of a permanent for at least the foreseeable future. And real estate is a great hedge against inflation. At the end of the day, how it hedges is that during inflation, typically rents go up at a pace to keep up with inflation, more or less. And that's the key message. As long as you can keep pushing rents up, the values will continue to increase, as most investors look at these assets based on the income they generate.
Not only that, what I've learned is, rents do go up, but you're also building that appreciation with that's growing tax. That's growing tax deferred. You don't pay taxes on it until you do it. So, but that's our lending.
Have you ever figured out what is the value of the 35% equity share that you've given them?
And I have to say, I have to put a disclaimer on this. Okay. Past returns are not indicative of future. It's not. Right. I mean, it's not, okay, because we've got a crazy inflation. I mean, on some of our lending deals, we've got people making 20, 30, 40, 50%. Okay, just because it's been
not annualized inflation, just return, annualized returns, more like total returns 50%. They only get 6% in the interest and but the return over some years is 50%.
Yeah, I feel we've had some that have been even better than that. But I mean, I feel comfortable saying that this history shows on the lending side, you're going to make somewhere between 10 to 16%. I'm comfortable giving
between the interest and then the shared appreciation.
Correct. I'm comfortable giving with that. It's been more than that for the most part, but once again, I can't predict the future.
Very respectable number. Obviously, it's been hot. The returns have been very
good. Yes. Now the turnkey, that's when we sell to the investor, right?
That's the program number 2.
Correct. And whether you do lending or turnkey, we tell our investors there's only two things you got to do: wire the money to the title company and look at your statement every month. They're totally passive. We do everything for them, right? So the turnkey model, we're selling it to them. We're property managing it for them. We're doing everything for them. And the turnkey the turnkey has been much better than that the last 7 years. It's been
because the markets are appreciated.
Because the market's been crazy. We've had investors that have looked up, and we just had one investor looked up and he sold the property, doubled his money in 6 years. So I mean, but is that going to happen in the future? No, I can't. I'm not going to say that, right? But it could. Like I tell people this: do you think we're going to see the same appreciation the next 5 years? And my answer is yes. But I don't know what the dollars will buy at that time. That's what because I think the inflation is going to take a hit. That's what I think. So,
well, from a money supply problem, the U.S. money supply has been growing at such an accelerated rate. If we sort of follow the trend is your friend. It may continue, right? The government seems to have little interest in tightening up the belt. They just, it's easier to borrow and spend.
I personally believe they can't tighten up the belt. I don't believe they can raise interest rates too much because they can't pay it on the debt. That's what I believe. But and so I don't think they have many tools left in their toolbox, and I think they just have to keep inflating the currency. And the other thing that and I know you being in real estate just like me, this, that the supply chain's really messed up right now. And that's causing prices to go up too, because you can't get stuff. I've got friends that are builders and they can't get the materials. They can't get materials they need to do their projects and so forth. So, that's another area to where I don't think it's a good sign for inflation either.
Yeah, and too many people talk about the supply chain coming back into a norm, but it doesn't seem to happen too fast. It's continuously, we're post. I don't know if we're post-COVID. We're not post-COVID. We're still in the middle of COVID, obviously, with the new wave. But it is certainly something that probably might take a few years to normalize, at least a few years. During these few years, the limited supply and then strong demand will continue to increase prices. It's the market equilibrium. Market can't seem to find an equilibrium. So this cost-driven inflation is still happening and probably will continue for at least a few more years, as long as kind of COVID is still dominating the thought and breaking the supply chain.
I couldn't agree with you more. Like I say, none of us have crystal balls, but
wait a minute. I used to have a crystal ball, but it broke. I just can't find another one for sale.
Yeah, I never had one, so you're lucky. Yeah.
But all right, so that let's kind of go with the trend. For now, we do see a pretty good trend. So are most people that invest with you, do they pick a turnkey model where they basically, you buy the property, fix it up for them, and then they own it and you turnkey manage for them? Or do they prefer to do a loan with an equity kicker, which is a little bit safer, feels a little safer, but they're a little different from each other? Well, what do folks mostly prefer?
Because of our price points, almost all of our investors pay cash for the homes.
Oh, they just want to buy and cash flow, right?
Have a free and clear asset and a cash flow. Yeah. Now,
is this possible to get financing on these things? The banks?
Well, okay, great question. Okay, there is not the typical Freddie and Fannie financing. No, you can't get that. Okay, but what a lot of people do, okay, they bring in, and I've got investors that have done 10 or 15 of these deals. Like, they've got people in their network, right, who are sitting on cash or in the stock market. They don't want to be there no more, right? So they'll buy the turnkey from me, bring in the lender. They'll pay them 6 or 7% where they were getting 1 at the bank, right? So they win. So, but when it's all said and done, the person they're bringing in, is covering the whole cost. And then my investor still has $300 to $400 a month cash flow. And then using the dentist term, which we talk about in Freedom Bonds, rinse and repeat. and they just rinse and repeat that. They just do another one, then another one, then another one. So yeah, we do it. We do have investors that are using private money to fund these deals. And then, of course, some of them, yes, community banks, some of them have good relationships with community banks and things like that they'll bring in leverage on those deals. But, you're not going to get Fannie and Freddie financing on manufactured homes. No.
Understood. Not an approved product. What about the portfolio lenders? Just curious. So community banks, relationship lending, like you could get some loans. What about the Lima ones? Some of these portfolio lenders that do.
I've never looked at it, to be honest with you. Okay, now, ironically, I'm talking to a couple of family offices right now, and I'm talking to a few different people that are very, very interested in looking at our portfolio. Right. So, but it's something that I am looking at, but I can't give you a good answer on it. I can't give you a good answer.
Understood. I mean, the price point with $100,000 is not such an expensive price point where people can't buy it for cash. It feels like people buy it for cash. They don't even need the leverage. Return is good enough.
And, I tell investors this, and you and I deal with a lot of the same investors, right? If you're already there, right? You're pretty much close to financially free. Why take extra risk, right? There's no, if you're already there, the free and clear assets are great. If you're trying to play catch up, yeah, then you want to, use all the leverage you can to play catch up. And so that's kind of that's kind of what my investors have done, and that's kind of their thought process for the most part.
And that is a safer strategy. No argument that owning some properties free and clear is not a bad idea at all. I think most people use leverage not necessarily for the reason that I guess some folks are catching up and they're trying to get a higher rate of return on their capital invested. But in general, it's a mathematical problem. Like I'm a mathematician, I would say that if I can get cheap debt leverage for long term, I would rather do that than get a purely cash and cash, because you can get your cash and cash magnified. So example here, and you tell me if the numbers are right or wrong, but if it's $1,400 a month rent and they paid $100,000, let's just, what are the expenses in that property? Taxes, insurance, without any leverage. Like what would be the expenses on a property?
Oh boy, you're probably, and boy, I hate to do this off the cuff here. You're talking probably, 200 a month taxes, 100 a month insurance. So yeah, probably 300. So you're probably 1,100 or something's left.
Oh, you got to pay for property management. So they're probably around.
Property management. Yeah, I'm sorry. So you figure you're going to be somewhere in the vicinity of 1,000, 1,000 somewhere under repair, 900 somewhere in there. That would be my guess.
So with all the expenses, about 900. So it's not exactly 1% a month, but it's close. So maybe it's like 10% a year, right? Roughly at 9% a month times 12 months, a little bit over 10%.
I do want to point out one thing though. We fix the houses up so good, they really don't see maintenance till about 4 or 5 years. They really don't. It's because we're replacing everything new, so we cut that expense out. So, but we always tell people, plan on 10% per year, right?
Yield.
10% of gross rents is what you want to plan for repairs down the road. But we've learned this too, that appreciation and rent increases have always outpaced repairs and maintenance. But
yeah, that's actually a great point. I wanted to convey to the audience, which you're doing absolutely the right thing by teaching them that they have to set aside capital expense reserves. Well, what you are saying is that these homes don't need immediate repairs because you've done such a great job repairing them. On the other hand, they have to budget for future at about
absolutely
here 10% of revenue. So $1,400 a month, $140 a month needs to be put aside into a reserve repair account.
If like most of my investors don't do that, but at least they've got to have it in their head that that's coming, right?
You don't need to move it into an account, but if you're not psychologically prepared, it's funny how it is. I like to use even more conservative number. To me, I say about a third of the cash flow. I mean, it really depends. So if you're getting $900 a month, you need to be putting aside 300, which is maybe a little too much. What you're saying is use 10% of revenues as a figure, which is a decent way to think about it, but it has to be set aside in investors' head that 5 years from now or so, or 10 years from now, you may need a new roof. If you didn't set the money aside, you have to come up with the cash. And mathematically, it needs to be considered as a capital X budget and accumulate somewhere in there some kind of a, at least theoretically, psychological reserve account.
And how we do it on our properties, we're looking at it that every 5 to 7 years, we're going to give the property a facelift, right? In the meantime, rents have gone up, it's appreciated, but we have to freshen it up again, get it ready for another 5 years. That's the way that we look at it. So, and so, yeah, we're going to put the money in at every 5 to 7 years to roll again. So.
Yeah, and that's a great point, but we'll go back to the discussion. So a few real simple and critical points. Folks should always budget capital expense repairs for the next term. Even if it's not major expense, even if you don't have to replace the roof, you have to repaint the house, maybe change the carpet, a few other things. Mm-hmm. Makes total sense. And then the other point that we're chatting, that these stuffs are not really, easily financeable, but if you can find leverage, if you do cash and cash at 10% without leverage, and you had leverage of any kind of leverage, even 60% leverage, you could still get that cash flow in the high teens. So for some people, it may not be a critical requirement, but for some other folks, it's a consideration, especially if you can use somebody else's money at some kind of low interest rates. So basically, if your cash and cash is 10%, but you could borrow at 6%, that arbitrage of 4% a year creates additional return or enhances the cash and cash. It's a mathematical figure, but it doesn't really.
Absolutely.
Yeah. So let's continue. Go ahead.
Well, what I was going to say is, and our company strategy is we don't sell properties, we refinance them. That's what we do, okay? Because we're taking our equity off the table tax-free, right? When you refinance versus we've had some big appreciation, so we bring in another investor, and we'll my CPA taught me that, and it was brilliant. He said you should never sell a house, right? So you're keeping the cash flow, you're getting your equity off the table, and it's tax-free, and so there's a real good strategy there for that's another podcast, but there's a real good strategy there too. So.
Yeah, I've heard that before, and my friends call it refi until you die. As great as it sounds.
Yeah, no, I've heard the same phrase. And from a tax standpoint, it makes a lot of sense.
Yeah, I mean, I'll add the following commentary on this point. So there are reasons to sell, and there are reasons not to sell, especially if you're happy with the cash flow and you're happy with an asset allocation, everything else, why sell, right? The reason typically people sell is if their return on yield has gotten down. Sort of imagine a scenario where the appreciation outpaces the rent growth substantially, right? And in that scenario, at some point, if so much trapped equity, even refi doesn't necessarily do the justice to get the cash out.
Yeah,
but before you sell, God forgive me for a final thought.
Yeah.
Before you sell, you got to have something else to roll the money into. And that's a consideration. If you can't, you should never sell in a vacuum. If you have a good idea where you roll the money into the next project, then it's a good play. But selling purely because you want to sell, what are you going to do with cash? That question will immediately come up. If you can't answer that question, then why are you selling?
I agree 100% with what you said, and our main strategy is refinance. But no, we've got some properties now that we're going to sell, and here's why: because the taxing authorities have caught up with the prices now, right? They know they're worth $150,000, $200,000, and I've got this massive part of equity in there now that the taxes went up so much it brings down the cash flow to where I can take that capital from that house when I sell it and reinvest in other properties that are going to bring a much better cash flow. So yeah, in that case, I agree with you 100%. You sell.
I think we're preaching on the same subject. If once your cash on cash return calms down because of the government need for taxes, and we appreciate and respect the government, and we're not. The government typically seems to always want taxes, and it happens. It's exactly what happens in many cities and towns. They figured out the property is worth a lot more now, and they're taxing based on that. They don't really care that the rents have not kept up. So at some point, you have essentially diminishing rate of return on your capital. And that's the only real time where you got to consider what I do, can I redeploy? Then the obvious issue becomes in what do you do with recaptured depreciation and a number of other things. And the reason we talk about it, because we've been solving some of these problems. For example, Temple Growth Fund 2, which we're working on now to launch, will have certain units that folks can participate in. We call them, let's just call them high depreciation units. The fund is still in the works. We haven't launched it yet, but the high depreciation units will get, say, $2 for every dollar invested. Again, not guaranteed. This is an estimate. So what folks can do, they can sell an appreciated property, get the cash, and the way to mitigate the tax liabilities and depreciation and recapture is invest in a new fund or a deal or a property where you can run a cost seg, basically get some accelerated depreciation and offset the gains, the passive investment gains with passive allocation losses. It's another discussion, but just a way to think about this. You always have to think about where you redeploy the cash and what's going to happen from a tax perspective. Because what you don't want to do is sell, put the money somewhere that gives you good cash flow, but then you still have a big tax bill. You're going to wake up and say, wait a minute, what just happened?
No question. And that brings up a really good point. That's why I love real estate. I love the depreciation side of it. You can do the cost seg if you want to. You can do the straight line depreciation. But, people, investors, and I've been guilty of this too, that you're looking at gross rate of return, right? You got to look at what your net rate of return is. That's the real number, right? Whatever you're paying in taxes, taxes are what eat up your return. So, trying to get as much as you can legally, morally, and ethically tax free or tax deferred, tax whatever. That's the key to successful real estate investing, in my opinion.
Yeah, I agree. Most people gravitate to real estate for one of the major reasons: you can grow your wealth effectively tax deferred for many, 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 many years. And so many people, I don't want to crack this joke, but I call it, once you keep doing it, you sell your soul to the real estate depreciation devil, because you got all this massive portfolio, all the depreciation you've taken. One day it comes in with a recapture. There's a ways to mitigate that risk, but a lot of people, once they get used to this, it becomes very hard to wake up one day and say, oh, now I want to pay the taxes. It's more like, where do I deploy the money to get more depreciation?
No doubt. And just for the record, my company, we don't do cost seg. We just do straight line depreciation for that reason. We don't do it.
Yeah, you don't have a big recapture, so you have a very fairly manageable recapture reason. So your sale problem on the depreciation recapture is not as painful as some other folks who've done the cost segs.
Right.
So, yeah, there's another discussion. I'll just mention this. So cost seg, right now we're in a bonus at 100% year one. We'll start phasing out. So for those who are still looking to get extra depreciation, 2022 is still good. 2021 is good. 2022 is still 100%, and begins phasing out at 20% per year. So although the CPAs have spoken with, they believe that there will be a renewal. There will be a renewal because it's been the norm for many years. There are both rich real estate Democrats and rich real estate Republicans that will influence the House and the Senate to make sure that it continues. Anyway, Glen, I appreciate your wisdom. So how would folks get a hold of you? What's the best way? I know you have a book out. I don't know if you want to give a little pitch to the book.
It's on our website, okay, and we give it away for free, okay? If they do decide to make a donation, we give it to a charity. That's what we do. We've got a charity that we give the money to, not looking to make money in the book, but it's called Private Lender Secrets. I did it with David Phelps, our good friend, right, our good mutual friend, and it's about private lending, right? It's a good read. So if they go to StrombergInvestmentGroup.com, you see my name behind me. That's how you spell it: STROMBERG. investmentgroup.com. And then like I say, there's more information for our company, everything else. If they're interested in learning more about us, we got a deal. They could set up a call with myself, a Calendly link, and so forth. And I'm different too in this way. I always give out my phone number. That people feel free to. I'm not formal at all. People can feel free to call me. It's 817-966-1258.
Thank you, Glen, for sharing. Thank you for being available. Appreciate your wisdom. And you have a great turnkey product. In some ways, your product, just hearing you and just seeing what's out there, is superior to your traditional turnkeys because they just don't have the product. They don't have the product with the ratios of the cash flow like a 10% yield. Today, to get a non-levered 10% yield per year is incredibly hard. Normal turkeys, you just can't find it unless, I don't even know if you are like really rough areas or somewhere there's no appreciation.
That's the beauty of what we do is there are no rough areas. They're not in the hoods. They're out.
Yeah,
they're
both
out.
Carolinas are great. Georgia is great. Texas is great. You guys are in great
good
areas.
Good school districts, the whole thing. They're not in the city, they're not in the cities or the inner cities and things like that. So yeah, we love our space, and it's been really good to us, and it's been working since 2006. So we love it. So
thank you for sharing. Thank you for your wisdom. Appreciate you coming as a guest on the podcast. Yeah, wishing you and your family Merry Christmas, Happy New Year, happy and healthy, and see you at the next Freedom Founders of CG event.
Sounds great, Mike. Thanks a lot, man. You're a great guy and great job. Great interview today. I appreciate you having me. Okay.
Thank you.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to bigmikefund.com or visit Amazon and type Mike's slot name. Keep listening and keep investing Big Mike style. See you on the next episode.